Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go, generally related to three different topics: wealth building, commodities, and/or financial topics. So let's just dive right in there, take a look, and see what people are sharing. If you want to follow me at Finance, and if you want to join our community, finding-value.com, that's where I dive deeper into all of these topics and how to turn ideas into investments and which companies I think are my favorites. You can see all of that information. And don't forget to click subscribe to the YouTube channel. Let's try to get to 50,000 at some point here. I would love your help. So Finding Value Finance, that's myself. XLE, which is a energy ETF. Still holding on above support while oil takes a detour lower. So we're still sitting right on top of this big support level. If we were to focus in on that, we are still above all of these trend lines that act as support. So I wouldn't throw in the towel yet. I know we saw a little bit of selling pressure, well, maybe a lot of selling pressure in oil, down about 3%. But we're still above support at this time. We'll see if it will hold. This is U.S. small cap funds. They see the second largest weekly inflow ever. And that was that big spike in the Russell 2000 just ripping on up. Past few days, we've seen a little bit of a pullback, and some people are speculating that maybe people are starting to transition into some of these investments because they think that interest rates could potentially come down. And it looks like the value stocks or some of these small cap stocks could benefit from that. We saw some pretty big movements in the real estate housing market, home builders specifically. So this is weekly inflows, and that's the second largest weekly inflow ever, back to 07. IEA mid-year electricity report. Despite the rapid growth of renewables, the brisk increase in electricity consumption, especially in China and India, is resulting in the use of more coal-fired generation to meet demand. And I think maybe that some people are caught off guard with this, but I think coal could be a really good investment opportunity given where it's priced, given some of the dividend yields that they're paying out, and given the situation that the world is in, where I think electricity is going to get squeezed. I think it will get squeezed enough over the next 10 years where renewables, I don't think, will make up enough of a chunk of the growth where it will actually offset the electricity growth alone. So I think we're going to increase our use of natural gas and coal, and we're going to squeeze everything in the world here coming up over the next 10 years for electricity demand. U.S. oil rig counts are down -1 to 477. We've got to be getting close to a bottom here. At some point, it just seems like the markets just don't care necessarily that rig counts continue to fall. So we're going to have to see it in data, I think, in inventory draws, and we'll just have to continue to have inventory draws at some point, and prices move on up to activate more and more rigs. So right now, this has got to be real close to a bottom at some point here. I would say in 2024, it's probably going to occur 2024 in the later half year. This is U.S. equities see both secular and cyclical market cycles. The secular cycles are these big sideways boxes and the moves between them. Those are called secular bull markets. Cyclical are ones that are on a shorter time frame than the 10, 15, 20-year, 30-year pattern. Those are more like a couple of years, 3 years, 4 years. That's more of a cyclical pattern. So you get these up and down cyclical movements inside the big secular bear market as it goes sideways. I am betting on that we are entering a secular bear market for the U.S. equities, where we go sideways. The reason I think that will occur is because every time we go into a large expansionary phase of real estate and we have a shortage of commodities, that occurred in this time frame. It occurred in this time frame. It also occurred in this time frame. So commodity bull markets occurred in every single red box. In my opinion, we're entering a commodity bull market for a variety of reasons. A lot of the times when credit expands, which occurs under real estate expansion phases, we get these commodity, and there's a commodity shortage, we'll call it. That's when things get exposed and interest rates go up. So I think that's coming. I think we're in it already, although this person hasn't labeled that we're in it already. I'm sure that these were all labeled looking backwards, not forwards. So I think that we've already entered it. I think commodities versus stocks have already bottomed. It bottomed in 2020. We're going to start to work our way on up, and it will look very similar to a sideways action move, just like these red boxes here. And I like this chart very much. I like looking at these long-term, big picture view charts. These secular bull markets, if you look at them, this one lasted 16 years. This one lasted from about 20 years. So you add 16 years to this, and then what do you get? 2029 is what I would get there if you add 16 years to that secular bull market. I don't think we're going to have to wait that long, though. I think it's going to occur earlier, and it's going to be due not to the rhythm that this has, but more due to the inflation in the system and the supply of commodities not going to be able to keep up. So I think that we're at the doorstep of a very big commodity bull market, and that all of the things in place in terms of credit expansion and the supply side tightness, they're all in motion and are there. The conditions are all there. So speaking of this, so when we look at this, what we're looking at is for evidence for a commodity bear market or bull market to start. This is the evidence here. It says the evolution of copper mining capital intensity. The 2000s, it cost $4,000 to $5,000 a ton. 2012, $10,000 a ton. Today, it's up to $44,000 a ton per ton of copper. That's the capital intensity. This is going to continue to get worse and worse and worse. And although this is in the face of technological advancement from 2000 till today, so why are we getting this big move higher in capital intensity per ton for copper? We've got lower ore grades, longer permitting processes, more remote jurisdictions, higher labor costs, fewer skilled workers. And I would also state that we have more of a dispersion of where the copper is at. So there's smaller deposits at lower grades. So your cost per ton, you can't sink a bunch of capital in one spot if it's all scattered throughout, a bunch of different countries. So the capital intensity increases as your total ore in the ground declines. And it's not just ore grades, it's the total in the ground, because you sink capital into something, but you're sinking more capital to get these, mills and all this stuff running, and you've got less reserves. So it gets dispersed amongst less reserves. Coming on back, we've got the DXY. This is a big deal, guys. It's a very big deal. It says, if the dollar closes at this level, we will have a continuation bearish candle on the weekly chart. There are no bounce indicators on the higher time frame yet. The dollar remains on the verge of breaking below its symmetrical triangle, signaling ongoing bearish sentiment and potential further downside. Now, whether this breaks down or up, I don't know yet. We need to see a clear breakout. I'm not stating that this is breaking lower. A lot of the things in the market is based off of the strength of yields and the strength of the dollar. And those things are interconnected, the dollar and yields. If we get a decline in yields and a decline in the dollar, we're going to see things priced in dollars go up dramatically. It's a big deal. We're also going to see emerging markets rip. So we want to watch the DXY. We want to watch rates to see which direction they go. We want to see what the established trend is. This established trend when we went up here was a strong dollar. So dollar went up, and what it did is it started to weigh on a lot of the emerging market economies. Because what we're doing is we're basically crushing everyone with our dollar. It's through purchasing power of the dollar versus their currencies. So money is going to want to flow into dollar denominated assets. So this, when we went sideways here for all this time, we had a stable DXY. We had more stable interest rates because they were going sideways, and people put money into uh, the dollar-backed equities. So all of these, as you go on, you start to figure out that it's not just the market itself, it's what the market is being priced under. So if you're in a foreign country, it's better to hold US equities that pay dividends and get paid in dollars if your currency is weak in your local currency. If the dollar is weak versus the local currency, what they tend to do is sell the dollar denominated assets and they move into emerging markets where those currencies are going up against the dollar. That will see a big money rotation or flow. So right now we're trying to establish maybe a trend or a breakout in which direction are we going to go. It's a big deal because if we could break lower, I know how to play that. I also know how to play if it breaks higher too. If it breaks higher, that's probably going to be inflationary, and we'll probably see oil run. Breaking lower, emerging markets and some of those commodities, they're going to rip. So I think Powell knows this, and I think the bankers know that, and they're going to have to probably make a decision here at some point. I don't think it's just going to go sideways forever. And generally, what we see is the economy slow down, and that's what's going to lower interest rates is the economy slowing down. So then they're going to be posed with the question: do we lower rates, or do we keep rates where they're at and do stimulus behind it? I don't know what they're going to do or what they're going to try this time around. Confidence in national government. I just thought this was interesting. It says, can you spot a trend on this chart? What is it? Yeah, in every single country, the confidence in government is declining basically over time. At least that's the trend. So I just thought that was interesting and share it. The Crude Chronicles, it says, this is what an investment mania looks like, my friends. Major tech company and capital spending vertical. Yeah, that's what a bubble looks like. We had that big bubble here, which peaked out in 2014 and then started to come down in oil and gas capex. And then I think we are going to have to ramp that back up at some point here. But this is what it is in major tech companies. It's doing the big ramp, and we'll probably see it roll on over here at some point. Brandon Balo says it takes 29 years to develop a new mine in the United States. But yes, we'll have the metals we need to achieve net zero by 2050. And we'll do it without China's help. LOL. So this is the United States, 29 years for the global mine development in terms of time. How are we going to get to these net zero 2050 goals if it takes 29 years to develop a mine in the United States? And my answer would be we're probably not going to develop mines in the United States. We'll probably have to develop them somewhere else. But it's not looking good. It's not looking good to meet those goals. JSG says latest comparative inventory analysis with the EIA data through 7/17/24 total commercial inventory petroleum stocks. Other oils are up 8.5 million barrels. Wow, implied WTI fair value price of $72. We're $9 overvalued from today's current price when using commercial oil inventory levels. Scrolling down, Lance Roberts, currently 50% of the 10 indicators for market peaks are triggered, compared to an average of 70% during previous market peaks. This suggests that the market may not have reached its peak yet in terms of Bank of America's opinion. When I look at the charts, they look pretty top heavy. Now, they could obviously reverse. That's only a short-term market signal that I'm looking at, those bearish engulfings that I see. But we're 50% of the 10, and usually 70%, I guess, is needed for market peaks. ICE and hybrids will dominate vehicle production over the next 3 to 5 years. And he says, I still don't own enough platinum group metals. So Trump vows action to end electric vehicle mandate on day one. The candidate uses address at RNC to criticize green news scam. Biden has made shift to clean vehicles one of his top goals. So that very well could drive demand, but I think we're going to hybrids no matter what. It doesn't matter what these politicians will necessarily put as a mandate. What I think is a bigger deal is, do we have the minerals to actually support electric vehicles and the adoption that most of these people think they can do? I don't think we do. So I think hybrids they're going to come no matter what. And the market will probably demand it anyway. So it'll be a combination of those multiple things. Pricing will also drive it too if copper gets too expensive. Here's Grady. He says, yet one more chart that helped me call the commodities bear market low back in 2020 in real time. Pink lines are untouched. Still expecting $250 to $300 oil per barrel in today's value. Pink route still looks probable. Second inflationary wave incoming. This bull is a true lifetime opportunity. And this is the monthly candlestick 16-year chart. You see the false breakout, and that false breakout, I call it the slingshot cheetah. It's like pulling a rubber band back below your resistance support levels and then ripping it to the upside, and then we've got this consolidation going on. So I do think, yeah, we're gonna head up. I don't know the exact timing of it. Don't know what detours we might have along the way, but I do think towards the end of the bull market, oil is going to be one heck of a great investment. I think the companies are well positioned too. The companies are cheap in terms of price per cash flow. I think they're well positioned to take advantage of this big move. And what it's basically signaling us is that we could see a large drop in the dollar. The dollar. So that DXY we looked up earlier, that would fall to the downside, putting upside pressure for oil and all these other commodities. It's not so much about oil. It's more about the value of the dollar. Here's another one. It says this ratio chart shows how historically undervalued gold is relative to the U.S. currency supply. So gold has a very long way to go compared to the M2 money supply. And silver will outperform gold. And silver miners will outperform silver. And platinum will outperform silver. It's a lifetime opportunity. And that's his opinion there. And this is gold versus the M2 money supply. We've broken the downtrend here. We're ready to move on up over time. These are big long-term trends that we are looking at. He says, look at the two very similar positive divergences and what happened after the first one back in 2005 when it broke into positive territory. Big move. I think something similar is coming. This is the U.S. Conference Board Leading Economic Index. It's down 14.2% off of its previous peak in recession territory. So when we look at this, what this chart is showing us, this is the Conference Board Leading Economic Index months between the peak and the recession. The peak is when it drops down. So whenever we see these dropping down, we see when does the recession occur, and it's this gap between when it first came down and then the recession. So it was 1 month, 7 month, 8th month, 14, 16. And that's that gap between the recession and when the indicator came down. 10 months, 20 months, a little larger gap there, 9 months. And then we're currently 30 months from the previous peak. So this is by far the longest when looking back to 1959. And what it says down here is, the number of months between the most recent LEI peak and the month before a recession. It says recession dates are based on the Fred US RECP series, which identifies the business cycle peak through the period preceding the trough. And the purple line represents the Conference Board Leading Economic Index. And we're 30 months from the previous peak, which means we might have already gone through a recession. Remember that some of these guys were redefining what a recession is. I think that was a couple years ago. And they're like, well, it's not 2 months in a row. We're going to redefine it. Maybe we already went through it. It's hard to say. Or maybe we're already in it and going through it still, potentially. Here's Kevin Bambro. I just wanted to read this. He said, that's the thing in life. You can 10x plus stocks like Paladin from 20 to 22 after having 100x Paladin from 03 to 07, plus 10x and 20x countless stocks. You can nail calls on coal, uranium, moly, cobalt, gold, silver, copper, nickel, and so on for multiple cycles. You can make 1,000x on uranium futures. You can make a leverage bet on physical uranium and 5x that. It says, but there's always someone waiting on Twitter to take an exciting moment when you've accomplished something you're very proud of, and they use it as an opportunity to take a dig at you. Meanwhile, they have no clue that this book was written because of an ethical passion I have that makes me feel obligated to share what I've struggled to learn, how I've struggled with depression and trauma, including feeling like completely giving up on life at times, lost my will to live, how I've struggled with substance abuse at times and carried excess weight. Most importantly, how I've had to dig down, branch out, and grow to new heights, often struggling alone with my demons, plus how in my late 20s, I finally decided to get serious about investing and read all I could on the subject. Applied those learnings, and despite never finishing university, was able to not only get a job at the top hedge fund in Canada, rose to be a top performer over the following decade before retiring at 43 years old. Because frankly, the game didn't give me a thrill anymore. It took me another 10 years to figure out why. And a big part of why I had to move on is because what's most important to me now is spending time with good, kind, caring people that care about others while balancing all of life's challenges. The three pillars of true wealth are hard to achieve: mind, body, and finance. There's always someone trying to drag you down. Never let them get you down, and rise. And what I want to say there is, everyone goes through their struggles throughout life. Everyone is trying to become better for the most part. Not everyone, but a lot of people. Everyone's going to go through struggles. Keep going on. Keep breaking through those barriers and get to where you want to go. If you want to retire early, obviously the things that you focus on, the things that you repeatedly practice to get better at, hopefully you do eventually get better at those things. A lot of it is persistence, and a lot of it is just continuing to go at it. I got that from sports. I played sports when I was younger. I got that through weight training and everything I've done kind of in life. So I'm just going to try to continually improve being an investor, continually improve my entry points, and try to get better. And that's part of the game. So just wanted to end on that note. So give me a thumb up for the content. Subscribe to the channel. We do have a question and answer session going on right now. So if you guys want to join, you better jump on. It's at 7 a.m. We generally end those around 10 to 11 a.m., depending on how long it goes. But that's what we've got for today. We'll catch you next time. This is Finding Value.